Good morning, everybody. Thank you very much for joining us this morning on our item here this morning, which is two items. My name is Aengus Burns. I'm an advisory partner in GT, joined by David Farrell, Corporate Finance Director. And today we are going to, if I can get a control of these slides, we're going to look at insolvency, restructuring, and funding advisory. So it's a two-pronged presentation. I will look at the first part, which is very much focused on the restructuring piece, and David will talk to the second part, which is very much around the fundraising piece, and we'll try to link the two insofar as we can. Obviously, the ability to raise capital and the ability to restructure the affairs of businesses are interlinked. In terms of GT, we have 7 offices around the country. Hopefully, most of you will be aware of us. I think we're north of 1,600 employees at the moment, 50 or so partners, and we have a strong regional representation also. So I'm going to look at the first part. I hope to be just under the half-hour mark, and specifically looking at the insolvency toolbox in terms of what is available to both companies and businesses, sole traders as well, in terms of formal insolvency settlements and restructuring. Of course, you know, the backdrop is formal arrangements, but in many cases informal restructuring is also possible. But really the rules and the manners, let's say, are put in place by what formal arrangements are open to, I suppose, impose a settlement on creditors and debtors alike. As I mentioned, David will pick up on the funding landscape, challenges there in terms of fundraising, and talk to business plans and financial modelling. So in terms of my first part, I talked to the restructuring toolbox because it's important to know what official and statutory restructuring methodologies are available at the moment. They have been improved. They're constantly being improved. The SCARP process, the rescue process draft bill came out in May, and we're looking forward to having new legislation around the Small Company Administrative Rescue Process, or SCARP, come September. It's a further examinership light type regime. But at the same time, just to reiterate that, you know, in many cases, depending on the numbers of creditors, a restructuring is possible on an informal basis. But very important to understand what the restructuring, the formal toolbox is like, and generally the formal restructuring is favoured by multiple creditors. You know, where you have multiple creditors all jostling for position. We'll look at some of the ways the creditors can jostle for preferential status, let's say, or preferential position ahead of other creditors. It's harder to get multiple creditors to agree. So sometimes a formal settlement is necessary. As a rule of thumb, the less creditors there are, the more the ability to agree an informal settlement where all creditors consent. I suppose a formal settlement tends to be where the settlement is imposed, and perhaps not all creditors agree to it, but the settlement is imposed upon them. Generally, we look at the base case scenario, which tends to be liquidation. So in that respect, we'll look at a statement of affairs, what the priority of claims of creditors in a corporate statement of affairs, and in terms of a sole trader position is, and that really is the base position there to try to negotiate an informal settlement. Big question that I have with David frequently is, do we put the fundraising, do we put the investment in now when there's a problem with the balance sheet, and try to cash flow it out over a number of years, you know, working through the onerous contracts or the legacy liability? Or do we do a settlement now, hanging the carrot of an investment to pull the dividends, to pull the settlement through, and introduce the investment after the settlement? So I suppose that's one of the big questions for directors and entrepreneurs to make. And of course, there's no point doing this unless there's a future viability piece. So look, let's move to our base case, which is liquidation. The most common form of liquidation is creditors' voluntary liquidation. The company has to be insolvent, unable to pay its debts as they fall due. So it could be that there is creditor support, and debts are not due immediately. So insolvency, it might seem straightforward as to what insolvency is, whether or not you can clear your debts if possible. But if your debts are not being called in, you may have the support of your creditors, and it's up for debate as to whether the company is insolvent or not. There's no court involvement with the creditors' voluntary liquidation, so it's an out of court process. Directors call a creditors meeting to appoint a liquidator with 10 days notice once they're of the opinion that the company is insolvent, that it can't pay its debts as they fall due, and the shareholders pass an ordinary resolution. That's a 51% resolution to wind up the company. So when you have a 50-50, 2 shareholders and 1 disagrees to appoint a liquidator, you're not in a position to proceed with the creditors' voluntary liquidation. You might have to look at a court option, which is on the next slide. So advantages of a corporate winding up is the company directors generally have control over who they nominate to be liquidator of the company, subject to ratification by creditors. So creditors will have a vote at the creditors meeting based on the value of their creditor claims. So they have proxy forms which they can vote. And in some cases, they might want to influence the outcome of who is appointed liquidator. In particular, Revenue have been quite active on that piece. So it's important to know who your creditors are, how much they're owed before embarking on a creditors meeting and liquidation. But then it's everything is handed over to the liquidator, who deals with all the company's assets and all the company's creditors. So it's very much a kind of a relief for directors. They lose their powers, but the responsibilities then pass to the liquidator to deal with the affairs of the company. One of the big benefits is the state indemnity to pick up redundancy, which I know is a very significant issue now. We had a temporary layoff of 4 to 6 weeks up until last year, and that has been extended indefinitely now, or it's definitely extended to the end of September. We're told that is the last extension for temporary layoff. So at some point at the end of September, we imagine there'll be many employees now demanding and being entitled to receive redundancy, and where a company is going to find the money for that. It might be through liquidation and the indemnity kicking in from the state to pay out on employee entitlements. But liquidation doesn't necessarily mean the end of the game. I did a number of liquidations last year where the assets might be sold to an associated party, and that associated party might pick up the business from the liquidated entity and continue trading again. So it's important that that's done at arm's length via the liquidator, be happy around market values, etc. But certainly liquidation isn't always the end of the game for the business. That's important to note. Some of the disadvantages there are reporting to the Director of Corporate Enforcement around the conduct of the directors. There is a potential for restriction or disqualification of directors should they not have acted honestly and responsibly in the affairs of the business. And in that respect, restriction might be putting in an amount of share capital, €63,000, into any other company that directors want to be director of in the future. Further downsides, unsecured creditors generally get burnt. They generally do not receive a dividend, and of course there's the reputational impact of liquidation. I gave a nod to the High Court liquidation route. I mean, generally this is where a creditor is looking for payment, and it's like pushing the entity right to the edge of the cliff. And if you get paid before it goes over the cliff, well and good. But if it goes over the cliff, the creditor generally doesn't get paid. So it's a kind of a high risk game to try to get paid an amount, and that's generally the route that we see for court liquidations, where a petitioner makes an application to the High Court to put an insolvent company into liquidation. But also, as I indicated, where there might be a problem with the composition of the shareholders, it's possible to have a friendly creditor appoint a liquidator to the company if protection, court protection is required for the assets of the company, or alternatively for the shareholders themselves to petition the wind up of the company on the basis that there's equitable to do so. It avoids that 10-day notice period, but once it kicks in, it follows the same course as the creditor's voluntary liquidation. So there's no need to go back in and out of court after the original official confirmation of the liquidator. Pre-COVID, €10,000 of a claim was enough to petition the wind-up of company. That has now increased to €50,000. So the advantages I've outlined, one I've mentioned there is around 2P. This is transfer of undertakings for employees. Okay, so this is where you might liquidate a company and the business of the company be purchased from the liquidator, and then the employees in general would have a claim then for their service in the new business going forward, and that applies in a creditor's voluntary liquidation. It doesn't, however, apply in a court winding up, where specifically the EU legislation indicates that there is no transfer of undertakings in a liquidation appointed by with a liquidator appointed by a court. So that's an interesting differential there. Otherwise, very similar to the creditor's voluntary liquidation. There is such thing as a provisional liquidation. It was more common maybe 10 years ago. Certainly GT has done a provisional liquidation in the past number of months. And there's a kind of a hiatus period of a week or 2 weeks between the appointment of a provisional liquidator and the confirmation of the liquidator's appointment at a hearing date. So essentially what might happen is the company might jump into court, have a provisional liquidator appointed, court protection over assets, and then the hearing date then would follow 2 weeks after that. Oftentimes in supply contracts or customer contracts, there might be a clause around liquidation that nullifies those contracts. However, the provisional liquidation is not a formal liquidation as such until the official confirmation. So it may be possible for the provisional liquidator to sell businesses as a going concern during this period. And obviously you want to have your purchaser lined up quickly. But again, we've done this a few times with a degree of success, and important to be able to differentiate between provisional and the official confirmation. I spoke about a statement of affairs. Whenever there's a problem and whenever there's a situation where creditors might not get paid, it's important to look at the position of creditors, and that's done in the form of a statement of affairs. Okay, creditors are dealt with in the form of a waterfall, and I'll show you a template form now in a second. For a creditor's voluntary liquidation, the statement of affairs is prepared by the directors in advance of the shareholder meeting and the creditors meeting, keys for the creditors meeting, and it's presented then at the creditors meeting, detailing the company's assets and liabilities, both on a going concern basis, but more importantly, on a winding up basis. The key differential there being the realizable value of the assets is generally less on a winding up basis. And it also reflects the priority of creditors' claim in that waterfall format. So where secured creditors and preferential creditors would rank ahead of unsecured creditors. And you can see that format and waterfall on the right-hand side of the page in terms of secured creditors supported by a mortgage, costs of the liquidator, super preferential creditors, which is employees, PRSI, then preferential creditors, revenue rates, and employees, and then secured creditors being debenture with unsecured creditors to follow after that. Slightly different formats for court liquidation and examinership, but generally that insolvency waterfall applies. And this is what a normal creditor's voluntary liquidation statement of affairs would look like. You can see the column there for going concern, and then you have figures for the winding up basis. So for instance, debtors might be carried at $500,000, but the winding up value of debtors in a liquidation might be considerably less depending on the industry. In construction, because of liquidated damages claims, it can near zero or 5% or 10% or something like that on a wind up basis. And then, you know, totaling all your realizable value of assets, and then who is first in the pecking order to get dividends? Well, you know, secured creditors, super preferential creditors, all the way down to unsecured creditors. There are ways the creditors can skip the queue. For suppliers, there's such a thing as retention of title, where ownership of the goods does not pass until goods are paid for in full. Okay, so often there is some kind of a clause at the bottom of the terms of trade or the invoice indicating whether there's retention of title or not. So suppliers in theory can grab their or threaten to grab their stock back unless they're paid in full. So essentially they're skipping the queue. Similarly, on creditor debtor contras, with a personal insolvency arrangement there agreed this week, and there was credit card monies coming into the bank account, and the bank creditor applied a set off of those monies coming in. Very difficult to reverse that. So effectively, one form of skipping the queue, and there are a myriad of other ways of skipping the queue in terms of liens, judgment mortgage, seizures by the sheriff. In construction, certification and warranty is quite important. If windows or plumbing is supplied, there might be certification required. That certification won't be forthcoming unless goods are paid for in full. So, a liquidator trying to realize value, or an examiner, might allow those creditors to effectively skip the queue and get paid in full or substantially more than others. Of course, there's personal guarantees as well, which don't form part of the corporate insolvency settlement, and essentially where the liability overleaps the limited liability status of the company and falls often on the company directors. In that case, there's a suite of tools which I'll touch on, relating to personal insolvency that can be dealt with later. And we have a team in GT that works through hundreds of personal insolvency arrangements, and often they see PGs dealt with a cram down in personal insolvency arrangements. In an informal settlement, obviously, you might want to bring in the personal guarantee with the company liability in terms of an overall settlement. Very different then to liquidation, which is where the company dies effectively, even though the business might survive along another entity. But examinership is where the company survives along with the business. Okay, and in particular, goodwill, customer goodwill in liquidation might fail sometimes. It might not be able to skip from the liquidated entity to the new corporate entity. But the idea of examinership is to preserve that goodwill, preserve contracts, and preserve as much value as possible by preserving the corporate entity itself. Okay, so the idea here is to facilitate the survival of the whole or part of the company by dealing with historic liabilities through a scheme of arrangements. That's a write-down of amounts owed to creditors, and the future profitability of the business by injecting new monies in for working capital investment going forward, okay, only to come in after the write-down with the creditors, okay, and also complemented by perhaps a renegotiation of onerous contracts such as leases. Maybe landlord leases might have the threat of repudiation and might be renegotiated to more reasonable possible levels, and changes to work practices. And that's coupled with this write down of amounts owed to creditors. So if you can visualize a balance sheet in liquidation where you have liabilities and obligations exceeding the assets, the idea is to take a scalpel and to cut down the existing liabilities and future commitments of the company, to right size them, and then to bring in an investment into the top half of the balance sheet, into the assets in the form of an injection of working capital going forward. So you're right sizing the balance sheet, and you're fixing the historic problem that the company had, all on the basis that you have a decent, viable business going forward. Okay. Some of the reasons I've kind of outlined could be legacy issues, onerous contracts that the company's bound into that they need to amend or get out of, a broken balance sheet. I spoke about liabilities exceeding assets. A big issue now for hospitality and retail is landlord leases and the ability to repudiate leases or get out of leases. So often it forces a restructuring and an amendment of those lease terms. And all in all, we're trying to protect business, and key is to protect employment because of the destructive nature of liquidation. So trying to avoid employment loss, and in turn, the cost on the state of having to pay out redundancy, etc. So what are the key characteristics of success? Keywords here: a reasonable prospect of survival. So this is about the viability of the business, the ability to attract sufficient investment through. The judge will want to see new investment coming into the company. And this is supported by a requirement for an independent expert's report at the outset of the liquidation. Answers about 13 questions, including the reasonable prospect of survival and why the company is a good candidate for examinership. It's not cheap. The downside to it, and we'll look at SCARP later, is the downside is that you're in and out of court. So it is costly. You have court scrutiny. You have that requirement for investment going forward. In essence, you have 4 sets of professionals here. You have an independent accountant, you have an examiner, you have solicitors to petition the examinership, and you also have solicitors for the examiner. Okay, so there's a significant cost there, often in excess of €100,000 for an examinership, which is often out of the scope of cost for many SMEs. We spoke about the independent expert's report, focusing on the viability and appropriateness of the examinership process for the company. The examiner doesn't have hands-on control, so the directors continue to trade the company. The examiner is there to put the deal together, get the investment in, and do the write down with creditors. Okay, court protection is there to protect effectively a standstill on creditor action against the company, allowing a time frame of now 150 days. It was 100 days pre-COVID, but a temporary time frame of now 150 days to get the deal done. Okay, and key here is not to have creditors prejudiced. They must be better off than they would have been in a winding up or liquidation. A number of years ago, Examinership Light was brought in. This is an attempt to bring down the costs by, rather than availing of the High Court, the Circuit Court was possible to be used. So generally, legal costs are less. The jury is somewhat out on this. We found that maybe the capacity of the Circuit Court judges wasn't there. Maybe several adjournments, and maybe the costs were not dissimilar. But I think things have improved on the Circuit Court in terms of Examinership Light, and that lower cost option is still available. So we talked about a 150-day timeline, a number of reports in and out. If the examiner feels that he or she cannot get the deal over the line, then we'll apply to the court to remove protection and straight into liquidation. At which point also maybe some creditors might look to seize assets by way of receivership, but generally a liquidator appointed and failure. However, if the examinership is successful, creditors agree to a write down of what they're owed, and then investment comes in after confirmation, then you have a successful company. One of the reasons why banks and revenue in particular don't like examinership sometimes is where examinerships fail. And where examinerships fail, you have those significant costs ranking ahead of other costs in a liquidation. So fees, costs, expense of the examiner ranking ahead of even receivers' fees and costs, and banks' costs and other expenses of the examinership, and then in turn the liquidation. So often it's the cost bit in examinership that is a great piece of legislation, I have to say, but it's the cost piece that seems to be causing difficulty. And this is where we'll look at the new SCARP rescue process, tries to address the issue of costs. We do have Part 9 schemes of arrangement, which is where insolvent companies can reach agreement with creditors and then apply to court to have that scheme blessed. There's a great deal of flexibility around the schemes of arrangement. I suppose the problem with the schemes of arrangement is the threshold for creditor support is very high. It's 75% of all creditors need to agree to a scheme of arrangement, whereas in an examinership, you only need one class of creditor at 51% to agree to a scheme. So in theory, an examinership is quite easy to get over the line if the judge is happy, whereas a scheme of arrangement has a very high voting threshold. There's no ability in legislation to repudiate landlord leases, and it doesn't impact secured creditors or banks. Okay, so we haven't seen too many schemes of arrangement. However, in 2014, there was a further legislation there to improve the attractiveness of schemes of arrangement. And that's something that is a possibility. We might see more of it. Certainly doesn't carry the kind of costs that examinership carries. Wanted to touch on receivership. Receivership, I have to say, people get confused between liquidation and receivership, but receivership is to all intents and purposes repossession. It's repossession by a creditor. That creditor happens to have security over all assets or certain assets of the company. Okay, and how does it happen? Well, generally it's a loan which is in arrears, or the interest is in arrears, or the lender needs to move to protect their situation. So even though repossession might take the form of a buy-to-let property, and the receiver is appointed and sells the buy-to-let property, but it also might take the form, and we saw it very considerably 10 years ago, in the form of trading businesses, be them hotels, nightclubs, restaurants, where the receiver will actually trade the asset even for a number of years before selling it, and those powers of the receiver vest in the security documents which were put in place at the time of the lending. So look, it's repossession really. But I suppose it is a form of restructuring, in that there's the ability for receivers to sell on trading businesses onto new parties, whether that's back to the original owners or whether it's onto new parties altogether. But all the while, I suppose there is the potential there to protect employment and protect goodwill of a business. It's not all about corporates. There are many sole traders out there. We just got approval from creditors this week of a petrol filling station in the south of the country, where we had €1 million of unsecured creditors written off, and an agreed sale of the business as part of the settlement, and that was done by way of a person insolvency arrangement. There are two key person insolvency arrangements here. The debt relief notice is for very small money, but the debt settlement arrangement is up to 5 years of a term where dividends would be paid from income of the debtor. So it kind of puts a period of 5 years to pay, whether it's 20% dividend, 30% dividend over a period of up to 5 years to settle creditor debt. Okay, of course, it's possible to have outside money, maybe a rich auntie come in and monies be parachuted in and have the settlement done in 2 weeks, if you like. So to fast forward the process, but generally it involves a write down of unsecured debts. Similarly is the personal insolvency arrangement. However, that includes secured debt. The maximum period of time is 6 years. But again, often we see a parachute of external monies introduced from outside, new money coming in, and a bullet payment made to creditors. And certainly that was the situation in this example I gave of this week, which was approved, which is a business that a bullet payment was made in and around the order of 40,000-50,000 euro, which dealt with €1 million of unsecured debt. And we're going to see more of these for sole traders. This is not just about people with family homes and maybe the odd buy-to-let property. This really is suitable for sole traders who do not have limited liability and need to address their insolvency situation. Bankruptcy is there also, however, it means the end of the business for a period of time. So really, I'm not sure whether you could call it a restructuring. It certainly is a solution. But I think in terms of person insolvency restructurings, the DSA and the PIA are worth exploring further. Finally, I wanted to talk about SCARP. 11th of May, the draft bill came out by way of press release for the scheme for small and micro business administrative rescue process. So this is designed for small businesses, which are by far the majority of companies in Ireland. It's all about costs. It's trying to remove costs from effectively what is an examinership process. And it hopes to remove costs by trying to keep the process out of court. Okay, so essentially it's an out of court process, but unfortunately or practically, it can involve applications to court for a number of reasons, which we'll look at as well. But ostensibly it tries to keep the process out of court and thereby avoiding costs. It aims to have a shorter period than examinership. In terms of a similar person to an examiner, it has a process advisor, which would be an insolvency practitioner like myself. The rescue plan can be passed by a simple majority in value of creditors, so it's similar in that respect to examinership. A cross-class cram down of debts, so creditors get a write down of what they're owed. They can't be unfairly prejudiced, must be better off than in liquidation. And it does not require application to court for approval of the rescue plan, provided there are no creditor objections. So we're presuming no creditor objections. Whether that's logical or practical, we're not sure yet. But I would imagine there are many straightforward restructurings where creditors are happy to run along with it, and there's no requirement to go into court. And really, it aims to get those processes over the line with minimal cost. So just to look a bit further in what it envisages, and we expect to see the legislation in September or even sooner. I saw a headline yesterday, they want to try to fast forward the legislation, possibly something to do with the redundancy deadline of end of September. I think in some quarters, there's a view in hospitality and retail that we may be facing a come to God moment maybe towards the end of the year in terms of supports being withdrawn, and maybe creditors looking for payment. So it aims to have this process ready and usable by Q4 this year. So as always, statement of affairs to be prepared. Process advisor engaged to report on survival prospects of the company, not dissimilar to the independent accountant's report in examinership. A director's resolution then appointing the process advisor, at that point ceasing payments to creditor. Okay, the process advisor then consults with creditors and prepares a rescue plan. Okay, that rescue plan then is brought to the creditors by day 42, and then a 7-day period to vote on that rescue plan. So a 49-day process. Okay, 60% in number and 50% in value of only one class of creditors is needed. So the threshold is quite low. Now, if everybody agrees, then the plan can be adopted and imposed. However, if there is a creditor objection within 21 days, so if there's no objection within 21 days, then it's binding on all creditors. But if there's a creditor objection within 21 days, and you might wonder, well, on what basis could a creditor object? You know, this is a process advisor who's independent and is trying to form a plan here that's equitable to all. Really, it's around unfair prejudice. You know, for some reason, is the process advisor unfairly prejudicing the creditor? If that's done within 21 days, the creditor can object to court, and then we're into the court to confirm the process advisor's plan. A second reason why you might go into court is to get court protection, get a stay on proceedings from one or more creditors who might be trying to seize goods, might be trying to get judgment, or might be trying to appoint a receiver. So it's the ability to get a stay on proceedings from creditors, albeit it's not an automatic stay, it has to be applied for. And a third reason you might go to court is around repudiation of leases. So there is the ability outlined in the rescue process to repudiate landlord leases, no different from examinership. Okay, and that can be done as an out of court process with consent. But obviously, if there is no consent by the landlord, then it is into court for a third reason, similarly to examinership, to force a repudiation through. In most cases, repudiation doesn't actually happen. Common sense is met under threat of repudiation, and a settlement or some kind of deal around the lease, whether it's an exit of the lease or whether it's a change to the terms of the lease, is agreed. In terms of eligibility, annual turnover up to 12 million, assets of 6 million up to 50 employees. So two of those three criteria. Insolvent or likely to become insolvent. And that's a key test of whether a company is insolvent or not. And key here is the viability of the business, the same as examinership. We're trying to get the costs down, trying to limit court involvement. And we have the ability to repudiate landlord leases under this legislation, but again, it tends to be the threat of repudiation to force a settlement through. If creditors don't play ball, and if they're trying to seize goods or trying to take action there in the out of court process, then there's ability to apply to court for a stay on creditor action, similar to what is got automatically in examinerships. And again, we don't want to have creditors unfairly prejudiced. This is all about in the best interest of the creditor. So removing the law of the jungle, putting a bit of manners and common sense on dealing with creditors and getting a dividend out to them. So just to compare the two, it's small companies only. It's a direct resolution, no court requirement to petition the commencement of examinership. Around state creditors are excludable, so they're brought in to the fray, but they have the potential to opt out. Okay, so key here is revenue commissioners, and I have a box in the corner there as to revenue can opt out. They have 14 days to opt out of the process, and for the reasons around non-compliance or if there's an ongoing tax audit. The jury's a bit out on whether revenue will engage and always opt out or always opt out, or whether they will not opt out and allow the 14 days to pass and be bound into an outcome. Obviously, we hope that revenue will be commercial in their view on SCARP. Talked around repudiation of landlord leases. There's only a court application required where there's no consent. So if the landlord does not agree to amending the lease, then really you're into repudiation in the court. So again, you're into costs there. You want to have meaningful engagement before going into court for that. The process of repudiation is around calculating the claim for loss to the landlord. But as I said before, it's the threat of repudiation which encourages the deal to get over the line. So look, there's a touch point on the comparison between SCARP and examinership. The idea here is to remove the costs, but obviously for those three reasons I've outlined, it may be that the company has to go into court for one or more of those three, one, two, or three of those reasons, and that's where the costs start to stack up. However, one would have thought they'd be significantly less than the statutory requirement to go in and out of court in the examinership process. So look, I've run a little bit over time there, but hopefully that was of some help to you. We'll leave questions, if you don't mind, to the end. And I just want to pass over to David Farrell now to talk about the funding landscape.
Thanks, Aengus. That was hugely informative. Good whistle-stop tour of all the restructuring options. I think the SCARP thing is something we're going to see a lot of in the next while. Good morning, everyone, and I hope everyone's well. I'm conscious people are taking time out, and I appreciate that. I just want to touch on the next slide. This is the agenda for what we're going to cover. Just take control here 1 second. So we'll touch on the economic context and challenges. Look, this is quite a busy slide, but it's good in terms of setting the context of the key variables or challenges affecting the economy, and by extension, the availability of funding supports. So now, I have control now, apologies. The key takeaway for me really is that Ireland has performed reasonably well when you compare it against the EU and the UK. And 2021 is probably going to be a more challenging year, particularly given that the PUP payment has masked the potential unemployment. And if government supports are turned off a little bit too quick, there will be an issue of people going onto the live register straight from the PUP. But obviously there is the other element of the economy that we have to think about, and that's the lack of unskilled labour available for many of the sectors. Like, I know the PUP is about 210,000 at the moment, so it's only marginally fallen from what you can see in the graph there in Q1. Again, the big thing is business consumer confidence and government stimulus. And EU support has continued, and that's a critical aspect that we'll need over the next couple of years to deal with the substantial challenges outlined. The one thing that I do take a lot of comfort from, to be honest, is that the NTMA has Ireland fully funded for 2021, and the maturities and all the government debts are well spread out, which was not the case at the last crisis. And I think our blended rate is less than 1% across all the maturities, which is a big benefit. The other aspect is that has become very clear is really that there is a twin or even a triple track of SME performance since the pandemic hit. The first cohort hardest hit. They're still closed or on life support, really. They're completely reliant on government support, and whether they will be viable in the next 12 to 18 months is something that we're going to have to, certainly as advisors and funders, etc., we're going to have to keep a close eye on, as you'd expect. Arts, entertainment, rural retailers, smaller hospitality such as restaurants are all top of the list. The second cohort for me is those that have kept going on a reduced trade. That's mainly through adapting, pivoting to online sales, taking advantage of pent-up demand when they are in full operation. They have been generating cash flow, but the real effect is going to be seen on the balance sheet and whether there's going to be balance sheet erosion as they're increasing or deferring their debts. So they've benefited greatly from government supports, and there is an expectation that they will bounce back. But again, it's just keeping an eye on the balance sheet and that there is strength and there's a strategic oversight there in terms of what's coming down the line. And the last category are the guys who've actually embraced technology change, maybe prior to the pandemic, or were an essential supply service. They've roared ahead. Like many of our clients are actually performing extremely well, and they've been able to capitalize on the pre-Brexit work that they did, which really helped them from a COVID perspective. They've introduced digital transformation, have introduced lean, efficient business models, maybe taken a little bit more of the human interaction out of the business in terms of that not being as critical to the customer journey. So as you'd expect, SaaS businesses, tech businesses, med tech, multinational government servicing businesses, hygiene, logistics, they're all businesses that have been booming, and they've had the uptick due to Brexit or COVID, or from penetrating other markets from technological advantages. So there is a big wide divergence in terms of the SMEs and what they're seeing out there. So there isn't really a one size fits all approach. This next slide continues on that theme, really. It's the recovery graphs. So there's three sides of the economy. DIY spending last summer was a good example. That's a Z-shaped recovery. The economy experienced a W-shaped recovery due to the Christmas second wave. The government needs to, again, ensure it's not turning off the support tap too quickly. And the main reason for that is to try and avoid this U-shaped recovery. In terms of, your own clients, your own business yourself, or, if you're a funder, those businesses that you are funding, it's all about medium-term planning. Cash being king, making sure short-term liquidity over the last 12 months has been there and will continue to be there, and then how best to capitalize the business for future opportunities, because it's undoubted that the Brexit scenario has meant that there will be more opportunities for certain businesses, and the ability to defer liabilities, rolling up debts has been a big advantage for certain businesses. So the right side of the slide, as you can see there, they're the main challenges facing the businesses. But to me, it just shows how adaptable businesses have been, and their capital suppliers have supported them to ensure the economy is bouncing back. So with that in mind, I'm going to move on to the next slide, which is really what I call the funder slide. I suppose it's worth touching briefly on the environment right now. Ulster Bank's exit was undoubtedly a big blow, and then KBC followed that. I suppose the positive for me is that there's been a substantial amount of alternative non-traditional funders that have come into the market over the last 5 or 6 years. Like, I know it's probably hard to believe, but SBCI have actually partnered with 33 different funders to be in a position to have their schemes delivered. And I know some of them haven't been fully deployed, but the Future Growth Loan Scheme was a huge success. And I know there's another 330 million going through the door at the moment, and hopefully that'll be released. And I suppose the one positive that I can take from recent market activity is that Permanent TSB have hired heavily for their SME team, and they to me appear to be the most likely, after AIB and Bank of Ireland, to have an alternative funding proposition in that pillar bank area, given Ulster and KBC's exit. I know from recent conversation, they have about 2 or a little over 2% of the market. but their objective is to get to 10%, and that's the type of ambition, to be honest, that we're going to need in light of Ulster's pending exit. The other positivity, I suppose, is that there is funding available. Sorry there. I know from my own recent engagements, there's a large pot of debt and equity capital to match that ambition. So, especially in respect of technological advancement, new entry to markets or geographies, high organic growth, and there is strong support for buy-side acquisitions. We've seen pillar banks and non-pillar banks provide acquisition funding, particularly where there's a good opportunity and there's a synergy within the two businesses. And then there's been an increasing level of private equity investments. And I think there's starting to be a shift towards equity ownership funding as opposed to debt, as businesses are becoming more aware of the advantage of equity and indeed the disadvantages of debt from a growth perspective, certainly in terms of amortization versus putting in capital that doesn't need to be repaid for a period and allows that extensive growth. The big advantages I've seen is a couple of funders have come in and said, look, we don't want any payments for a period. We'll structure it. We'll give you a couple of years because we buy into your growth plan. And those types of non-traditional funders are a big advantage, because I think there is a place for everyone in the market. Once that's done, the lower cost opportunity of going back to one of the pillars, that probably makes a lot of sense. I suppose taking a step back for a second, the first thing that I always ask a business is, in terms of, someone coming in and saying, look, we need funding, it's really what the purpose and the need is and when do they need it, and what return they expect to give against it. And that kind of dictates where they're going to be on this slide. That's will dictate where you're going, where you need to go to, and it will also reduce the time frame to see who's the first port of call. Because one of the biggest issues probably I see is, talking to different businesses is, they've tried to do the funding themselves and they've scattered gun approach, and it looks very good with certain funders, and then at the last minute it's not going to happen, and it takes a huge amount of operational capacity out of those businesses if there's a lot of time spent on fundraising. So knowing where to go is very important. So like with the alternatives, the non-traditionals, they normally have a specific hook. So it might be a minimum maximum lend size. They might be very targeted to asset-like cash flow businesses, or they might be very targeted to real estate asset-backed. It could be technology or software. They might like distressed or special situation, turnaround situations, or they might only target with a pan-European cash flow business. And then pricing varies considerably. So it's very much horses for courses. On the private equity side, it's more around the return and the exit, and when they're going to see both. Every one of the private equity guys has slightly different investment criteria, but the number one is a strong management team. That's always the first hurdle they have to overcome, and then the sustainability of the business model, and then the last piece really being the market opportunity. They need to see that there's a bigger growth market opportunity if they're going to put actual equity into the business. So, like, the one thing I'd always say to potential businesses that are looking for equity, that team is huge, traction is huge, total addressable market. Just keep the 3 T's in your head, and then you have to look at the risk and return and the exit. They're the takeaways, we'll say. So the other thing to say is PE firms tend to be specific to certain sectors. So they'll have a knowledge, or they'll have an add value, and that's what I call the strategic add. So they'll have experience in dealing with a particular business or a particular sector and know how to drive it on internationally. This next slide is just showing the level of PE activity. Most of these deals we would have had some involvement on. What it does say to me is different deals prove the emergence of, or probably back up what I'm saying about the two divergent economies, tech, healthcare, financial services on one side versus hospitality, leisure, and high street retail. You can see none of those are essentially there. And the one key focus I've particularly had working with clients is, to get them to think about the funding and sell side positioning now for a couple of years' time. Like, it is a process, it takes time, but if you actually work on work on the bottom line, let's call it, or operational capacity, or bringing in some lean initiatives, or looking at digital transformation, it's going to add huge value to the bottom line, and that improves the offers you're going to get from private equity, or from a buyer, or from a funder. And so, you know, it's a very detailed process, but you know, it really helps in terms of pre-funder engagement. And sometimes you'll actually see funders encourage it, where they, you know, they put, you know, the likes of ourselves in to do a business review and try and stress out the cash flow, or see if there's strategic hurdles within the business. And you'd often see that with cyclical or seasonal businesses, where they have those cash pinch points. So just moving on to the next slide. You know, we've talked a little bit about this already. Each sector has its own issues, and then COVID and Brexit and inflation coming down the line, these are all pressures that have to be addressed individually. And then you're going to have the other situation within the sectors themselves. So, you know, we have subsectoral divergence. So take the example of a hotel versus an outdoor adventure tourism business. Tourism can be tarred with the same brush, but there's actually very different actual performances within those businesses. And you'll also see this in mortgage lending in particular, where employment in one sector isn't treated the same as employment in the other. And positioning the ask is absolutely critical. So there's two kind of aspects. There's risk and uncertainty, and you can manage or price against risk, but uncertainty is the thing that everybody's afraid of. So pricing tends to go higher and leverage reduces when there is a higher level of risk and a higher level of uncertainty. But there is financial metrics around that. So you have your you know, debt to EBITDA, your leverage ratios, and your debt service cover, which is essentially the available cash flow you have to meet your debt repayments. And then you also need to bear in mind the position of the funder that you're talking to. So because the level of provisioning last year, for instance, probably precipitated the Ulster Bank and KBC announcements in one way. And look, there will be casualties from a funder perspective, from a private equity perspective, from a company perspective, from the crisis. And that's why the funding assessments and the risk committees, they tend to be more robust than ever. And obviously the European Banking Authority has communicated that it was phasing out the lending payment breaks. The main aim there was to ensure the support provided by those payment breaks, or moratorium as they're called, is limited to bridging liquidity shortages, which were triggered by the lockdowns themselves. And it's important, I suppose, it was important from their perspective that you could identify an unlikeness to pay, and that assessment was the main criteria for them. So moving on to our next slide, the challenges, and these are the larger aspects. It's sectoral bias. So how to position the ask is critical. We need to speak with the right person. That's number one in my head. You need an advocate for you from a funder perspective. You need someone who is on your side, and that needs to be someone within the funder, and someone who's representing you and is translating your business onto the right desk. And then right funder for your needs. I know it's repeating what I said, but knowing the market and avoiding wasting time is absolutely top of the list, because it's probably the number one issue for SMEs, is that they haven't managed to get a quick no. I think everybody would be happier with a quick no than have a process dragged out. And that's really the downside for me of Ulster Bank leaving, is the fact that, you know, it won't always suit an AIB or a Bank of Ireland to fund you for, you know, concentration risk aspects or various other aspects in terms of you know, certain regional bias, etc., or that they're funding something else in your particular sector, and there's less people to talk to, and trying to keep funder conversations alive is very important. And I think the only other thing that you need to emphasize in terms of talking to funders is you don't want this paralysis by analysis. You know, speed, to me, and across probably most of the clients we talk to, is probably more value than price. And that's where the alternative funders have been a big help. And then I've touched on this already, but asset-light options are much better than they were. But again, size remains important. It is very hard to get cash flow funding below $1 million with non-traditional funders. So, you know, with that in mind, to me, it's all about trying to think outside the box. is there any fixed assets can be financed? Can you release book debts? Can you release cash from your book debts? Is there any non-core assets which can be used to release equity? Is there sale and lease back options so you can use the cash flow into the business? And then other alternative finance structures, strategic equity. Strategic equity is kind of a fancy word really for getting someone who knows a bit about your business and that can help above the cash that they might bring into it. And then the other thing that is very important is trying to see what else is out there. Like, I suppose, like most people from my perspective, it's sorry, I'm not doing something there. You want to see what's available from the government, how they're going to support business. There's very significant add value to creating or sustaining employment for the government, and they do have supports. It's the biggest issue probably that's identified in talking to SMEs, that they're far less likely than the larger businesses to actually avail of the supports. There's actually 170 different supports from 27 different government bodies out there. Some of them are partial grants, don't have to be repaid. Most of them are based around increasing employment or energy efficiency. There are two kind of areas that you tend to get best supported in. What I would say to anybody is there's the Department of Enterprise online tool which categorizes each SME by sector and size, and you can get it in support.smegov.ie. And I think you should be encouraging businesses that you're aware of to have a look at this, because there is a lot in it, and you're going to get these slides afterwards so you can read through these in your own time. I am conscious of time. And then I suppose for me, creating certainty in uncertain times, and I know Aengus referenced it in terms of business plan and financial modelling, it needs to be done from a bottom-up approach. You need, basically what that means is that you're working out all of your costs, you're working out where your revenues are coming from, and you've built it client by client or customer by customer or supplier by supplier. You run various scenarios to understand the range of potential funding requirements, so you know what your working capital is. And then I suppose the key point is you have to assume that whoever's reading your funding proposition or your financial model knows absolutely nothing about your business, because something might be taken for granted, which is absolutely critical, and you know it day to day. And then the future projections have to be built on a number of assumptions, not just past performance. So if you know that you have a contract coming down the line and you can verify it to some degree, that's a more important way of actually presenting your business. Again, high level forecast plus and minus percentages, they're just hard to justify. Like, you can link it in with industry tailwinds and say that there's a compound annual growth rate within my industry, but when you look at the specifics, it doesn't actually tend to work out that way, because it's such a broad measure. And then the other thing is assuming the reader's financially literate or an expert in your business area. I touched on it again. Numbers without the story doesn't make any sense. So you need to make sure that you have the underlying assumptions, and then assuming the future, replicating the past. Again, that's a big issue. You need to tell the story as to where your revenue is going to come from. So I'm going to move on to the next slide here. To me, this is a very helpful takeaway slide. There's a huge amount in it, but it's the sort of thing that you should probably print off and stick on your desk from if you're a business, and say, is there anything I can do with any of these aspects today? Certainly before you go for external finance, is there a way of generating cash flow from stock or debtors or creditors, or a sale of stock, or longer payment terms, or getting earlier payment discounts? When that assessment then has been done, that's when you really should be moving on to external options and looking at the government options that we discussed earlier. So it's certainly, for me, look at yourself first from a business perspective. You have to know that you've got the most out of the business, and then you can explain what you've done in the story to any funder. So just concluding thoughts. Uncertainty is the biggest issue. It's very hard to measure it, but the key point is that the funding coming from Europe into the banks and the SBCI is there to allow for that uncertainty to some degree, and these 500,000 unsecured loans that are available through the SBCI they're very important opportunities for businesses when they are available. Some of them haven't been available in respect of the Future Growth Loan Scheme because they're completely used. But there is some ability in the COVID-19 Working Capital Scheme. The importance of a robust business plan and model to deal with the uncertainty, very important again. And then how you're going to deal with COVID closures, restrictions, second waves, and trying to quantify impacts for the business. I think the big benefit from the crisis has been the ability of people to pivot and learn how to deal with lower capacity, learn how to deal with lower demand, and trying to move what they would have considered fixed costs into variable costs, and also the technological or digital transformation aspects that we brought into business. And lastly, it's important to emphasize the need for properly capitalized for the medium term. It's all about being prepared. The one thing I will say is funders are open for business. It is case by case, and it's not a one size fits all. But when you get a proper proposal developed and it's positioned very clearly, and it has a robust assessment of the market and your competition, and you have a dynamic cash flow forecast to account for the different scenarios, you're putting yourself in the best position to actually get funding. So I'm going to leave it at that and pass it over to anybody who wants to ask a question.
David, thanks very much for that. It was really helpful. Just to tie it even a bit more back to the restructuring scenario, we had a whole list of potential funders there, okay, but also there's a myriad of different types of funders who would fund in a business. It could be private investors, or they could be banks, or whoever it might be. What's the kind of appetite for funding restructuring arrangements? So post restructuring, the pull of a business out of some of the arrangements that I've mentioned. What kind of appetite is out there for that?
There's definitely an appetite for it. It's all, and it comes after what I mentioned earlier, it's all about the team. And like you'll even notice it on your SCARP slides, Aengus, where revenue reference that they may exclude or they may not because of the history and the track record. Like you only have one opportunity to mess up your reputation, and dealing with people evenly and in the best way. Like the one thing I will say about the US versus Ireland, for instance, is it encourages entrepreneurs. It's okay to fail as long as they did everything that they should have done, and some of the issues they just couldn't get over. And I think that was the case, baby in the bathwater, in the last crisis to some degree, because there was some excellent businesses that probably didn't get the support, unfortunately. And it's something that I think the funders are conscious of, and it may not be the funder that you've been working with. You may need to do a refinance, but there's definitely a higher level of alternative finance out there. Like obviously over the last few years, we've refinanced a lot of what I call the NPL debts, the non-performing loans, and being able to get funding in the UK or get funding in Ireland and put a 3-5 year plan in place. Sometimes it can be expensive for the 6 to 12 months, but it allows the business to prove the aspect. And the only other point is, what are you going to do to change it? So I mentioned it earlier, but that digital transformation and lean and looking at what I call the operational advisory aspect, as opposed to just the transaction advisory where it's the deal. It's the preparation for the deal, and it's the 18 months out where you're going to go and you actually put a bit of planning together first, and you go, actually, John, I know I can add another 100 grand onto my bottom line by doing X, Y, and Z, and I'm going to prove it, and I'm going to tell them that I'm going to prove it, and then when I do it, I'll get the support for it. So communication is huge.
I suppose that the logic of, very hard for a funder to put money into a broken balance sheet or a business that is dragged down by historical matters. But the logic would suggest that once those things are fixed, the investment can come in there and be an incentive for creditors to accept an arrangement. But at the same time, depending on the funder and what their appetite is, and the risk that a restructured business falls over kind of straight away after, wouldn't have been the first time, they would be concerns, I guess.
Yeah, but I think that's fair. But like, we would have done a lot of restructuring, Aengus, and where you had to convince the funder that we needed to spend the 50 grand on marketing because the business is going to fall over, and you'll eventually get them to agree a standstill and say, well, look, we won't go down the receivership route, but we'll give you the chance as long as we know you're putting a little bit of cash in yourself, and it needs to be matched. If you are going to stay within the existing funding arrangement and you're not going to go with a new company, you need the funder on board. And if you don't have them on board, you need to make sure that there's a well-structured process and talk to the likes of yourself, Aengus.
There's a question there. Are these corporate rescues also known as legal pre-pack structures? So look, in essence, this is all accelerated deals, accelerated M&A, accelerated funding. The problem with insolvency and these procedures is that goodwill starts to dissipate very, very quickly. So any deals have to happen very quickly. So you'll note examinership was 100 days maximum period, now 150 days period. So there's a good bit of time there for the examiner to effectively maybe market the company to investment and get third-party investments in. But you notice the rescue process, there's only 49 days, well, realistically 42 days before it has to go to the vote of the creditors. So there's very little time from a statutory framework to really market the business and go out there. So really it does lend itself towards what we could call pre-packs, or having an investor waiting in the wings. So I think absolutely the rescue process leans towards that. Provisional liquidation that I spoke to earlier absolutely leans towards having an investor waiting in the wings. The insolvency practitioner, look, myself, there is some risk there that a creditor may turn around and say, hang on a second now, I'm unfairly prejudiced because there's all that goodwill in the business and you only got X amount of an investment in, which filters down to a liquidation. I suppose the defense might be that on a liquidation, there's only so much available to creditors. The time frame very tight to put the deal together. What you might see also is examiners, receivers, provisional liquidators putting an ad in the paper, maybe just notional to market the business. And of course, it's up to the creditor as well, could become an investor themselves and to put money in. So I suppose, yes, I suppose these really are accelerated M&A or pre-packs. They tend to lean towards pre-packs of having the investment ready and ready to drive the deal through. So, pre-planning before you press the button is very, very important in these processes.
And Aengus, just one other question, just around, and I don't know if it's clear yet or will be in legislation. Do you know around what the position is on advertising around SCARP?
So I don't know how it's impacted in law at the moment. There is an obligation. There's an obligation to advertise in Irische Vigul, which is the State Gazette, but not in national papers. Now, who reads Irische Vigul, the State Gazette? I do, but most other people don't. And that's where it's listed bankruptcies, liquidations, etc. But no, it's been moved out of the national newspapers. Not dissimilar to other liquidation processes where there's been I suppose a scaling down of those requirements. But no, ostensibly it's the onus is on the directors and the process advisor to get the notices out. Obviously, if creditors don't receive notice, then again, it could be said that they're unfairly prejudiced and they didn't have sufficient time to react within the time frame. So the onus really on the directors to ensure you pull all the creditors in. I mean, this is one opportunity to address the problems of the company. So pull all the creditors in, pull all the issues in, and get it sorted once and for all. Listen, we've gone over time, David. Thanks to everybody who attended today, and we will be circulating the slides after the event. Thanks very much. Thank you. Bye-bye.
Have a good day.